Okay, thank you so much for joining us today for our workshop on debt management. The goals for today's workshop are all focused on giving you a realistic perspective about debt, presenting strategies for managing your own debt, and supporting you as you consider your next steps. By the end of today's workshop, you will be able to explain common reasons why people find themselves in debt and the most common types of debt. You'll also be able to describe the value of using debt management strategies such as loan consolidation, budgeting, and debt management plans. You'll be able to compare various debt management solutions and create a personal plan for how to manage your own debt. So debt is something that millions of people deal with, and learning how to manage debt is one of the most important things a person can do to improve their financial health. I'm guessing that most of us here today have felt the effects of debt on your life. Maybe paying off debt has prevented you from saving money and forced you to live paycheck to paycheck. It may also be possible that debt has caused some tension in your home. Debt may impact you in a way that is as simple as not being able to go out to dinner as much as you'd like, or to accomplish personal goals such as traveling. According to one survey, nearly 75% of Americans are in debt, and most people owe an average of $38,000 in personal debt, and that doesn't even include their home mortgages. Being in debt causes us stress and can impact our relationships. 21% of people say debt has caused household tension, and 31% say that debt has an impact on their health. Plus, 15% of millennials say they have held off on getting married and having children because of debt. When we have high amounts of debt, we have trouble saving for retirement or a down payment on a home, both of which can help us plan for the future. This is the case for about 30% of millennials. As you can see, the effects of debt can seep into many different parts of our lives and can have a serious and lasting impact. The only solution? Debt management, and that's why we're all here today. So before we get into a deeper discussion about managing debt, we need to explore what it is. There are many different types of debt and many different ways a person can get into debt. The definition of debt is money owed for products or services purchased on credit. So debt includes the principal amount or the original amount borrowed plus any interest and fees. The interest is the amount we're being charged to borrow money. It's a percentage of the principal, usually charged annually. The interest percentage can vary depending on the product or service as well as your credit rating. When researching loans, it's important to consider the interest rates being offered. A lower interest rate means you'll pay less in fees to the lender over the life of the loan. On the other hand, if you're investing money in a savings account, you're acting as the lender, and therefore you want a higher interest rate so that you can earn more money on your investment. Now, interest rates can be either fixed, which means they stay the same for the life of the loan, or variable, meaning they change according to the economy or your credit agreement. A fixed interest rate is typically a safer bet because the amount you'll be charged over the life of the loan remains pretty much the same. With a fixed interest rate, there will be no surprises on how much you owe. Now, a variable interest rate is more uncertain because the actual amount you'll be charged can change according to your agreement and economic factors. That said, variable interest rates can be attractive when current standard interest rates are high. For instance, if auto loan interest rates increase considerably when you want to purchase a car, it may be advantageous to get a variable interest rate loan so that when the economy changes, your interest rates may decrease. Now, these are very basic definitions of interest rates and not meant to guide your purchasing decisions alone. What's most important is understanding that when it comes to debt management, it's interest that can get us into trouble. So let's talk about this example. This is the story of Ralph and his regrettable roof repair. So in the middle of a particularly wet winter, Ralph's roof started leaking. He called the roofing company, who quoted him $3,000 for the repairs. But Ralph had just purchased a new car and he was paying his son's college tuition. He just didn't have the cash on hand. Unfortunately, he couldn't wait. Rain was in the weekend forecast and his mother-in-law was coming for a visit. So he did what most of us would do. He charged the repair to his credit card. So $3,000 isn't too bad until you factor in the interest payments. So how much did this $3,000 purchase end up costing Ralph, and how long did it take for him to pay it off? Well, if the interest rate plus fees on Ralph's credit card was about 17%, and if Ralph was only paying the minimum monthly payment of $50 a month, it would take him 135 months to pay off his debt. That's over 11 years, and by that time, Ralph would need a brand new roof. So what's worse, Ralph will end up paying an additional $3,743 in interest for the credit card loan, meaning that when it's all said and done, this roof repair will have cost him nearly $7,000. Ralph was in debt. Now, his situation is not unusual at all. In fact, it's situations just like these that can contribute to many people's financial issues. Unexpected expenses come up all the time, and without any emergency savings, your options can be severely limited. Consider the 18% of adult Americans who were hit with a medical bill in 2019 in the amount of $1,000 to $1,999. Without emergency savings, they probably had to do what Ralph did, use credit cards to cover the costs, which increases their overall debt. And when debt piles up, it can have a long-term impact on your financial stability. Being in debt can often lead to a downward spiral of financial burden and even more debt. You see, debt affects your credit score. And your credit score is a number applied to your overall credit history. It's the number lenders use to determine how risky it is to give you a loan. The following factors are figured into your credit score: your payment history, your debt usage ratio, or how much you owe versus your credit limit, how long you've had credit, new credit, and your mix of different types of credit. Added up, these factors affect your credit score. And your payment history, paying your bills on time, is the most important factor in determining your credit score. It makes sense. If you haven't paid your bills on time in the past, lenders believe that you'll be likely to miss a payment in the future. So what about the total amount of debt? How much do you think your overall debt factors into your credit score? Well, the answer here is high. Having a lot of debt compared to the credit limit on your credit cards and loans sends a red flag to lenders that you may have trouble paying your bills if they give you a new loan. Having a low credit score affects much more than just the ability to get a credit card. Your credit score is checked when you apply for a cell phone, a rental property, or utilities. It may even be checked when you apply for a new job or for car or home insurance. Some companies may refuse you services based on a low credit score, while other companies may still offer you services, but with very high interest rates. Unfortunately, these higher interest rates just further contribute to a person's financial woes. So let's talk about an example here of Min and his friend Javier. So they both purchased homes for $300,000 with a 20% down payment on a 30-year loan. However, Min's credit score was much lower than Javier's at the time, so his interest rate ended up being 1% higher. Min didn't mind. It didn't seem like 1% was that big of a difference. But then Javier did the math for him. And you can see on the screen here that Javier showed Min that he'd be paying over $2,000 a year more in interest payments alone and over $60,000 in interest over the life of the loan. So to calculate this interest, we've got the equation up on the screen here, and it's also in your participant guide on page 3 for you to look at. So the calculation is interest equals P times R times T. Now, I, of course, is the interest. So P is the principal or the amount you borrowed, R is the interest rate, and T is time. So you can imagine that Min was pretty upset when he found out how much more debt he would be accruing than Javier. But Min's mortgage debt shouldn't have been, or should have been, the least of his worries, because you see there's many different types of debt and not all debt is the same. But before we discuss the different types of debt, there is an activity in the workbook that I would like, in your participant guide, that I'd like you to complete on your own time, but it's on page 4. So completing this activity will begin to help you assess your financial health. So on the worksheet, you'll record your gross monthly income, which is your income before any taxes are taken out, and your debts. So write down the total balance remaining on each type of debt account, your mortgage, credit card, student loans, car loans, and any other loans, and the monthly payment for each. When you're finished completing your breakdown, write down the last few charges you made to your credit card. So this exercise will help you determine what makes up most of your debt. Maybe it's your mortgage, or maybe it's your credit cards. So mortgage debt and credit card debt are tied for the leading source of debt in America. Now, mortgage debt makes sense because property is a huge purchase, but credit card debt, where is all that money going? Well, according to research, it's going towards entertainment. Dining and nightlife account for 15% of overall credit card debt, followed by hobbies and passions, personal care, clothing, and travel. So even though there are all these different types of debt, not all debt is the same. Some debt is even considered good debt, if you can believe it, and the rest is pretty clearly bad debt. So let's talk about what this means. So debt that provides you with a financial advantage is sometimes referred to as good debt because the financial rewards you receive from the purchase counter the cost. Mortgage debt is often considered a good debt because it's tax deductible and property has a tendency to appreciate or increase in value over time. However, if the property does not appreciate in value, or if the mortgage loan carries high interest rates, that mortgage debt can be a bad debt. Similarly, student loans are often considered as good debt because getting an education may increase your overall earning potential. However, if you take out a loan and never finish your degree, that debt becomes a bad debt. The worst type of debt is the costliest debt, and this usually comes from using credit cards with high interest rates to pay for things like dining and entertainment when you don't have the money to pay it back. Some financial experts consider new cars to be a bad debt also because they depreciate in value as soon as you drive them off the lot. Now, even though good debt can help you in the long run, it's still debt and it's still money that needs to be paid back. So to determine a person's financial health, we have to look at all of the debt, the good debt and the bad debt. And one way that lenders and other experts help assess somebody's financial health is to look at something called debt to income ratio, or DTI ratio. So the DTI ratio is exactly what it sounds like. It's the ratio of a person's total debt to their income. To calculate that ratio, you add up all of your monthly debt payments and divide that number by your monthly gross income. So your income before taxes are taken out. So let's look at this example with Adidia. So we're going to calculate Adidia's DTI. Adidia has a monthly gross income of $5,000 and total debts of $2,000. So using the DTI equation, that gives us 4. So that means Adidia's DTI ratio is 40%. Now you can do this for your own financial situation. So on page 5 of the participant guide is the calculation, and you can determine your own DTI, and then you can that will help you determine your overall financial health. So according to financial experts, your DTI ratio should be lower than 40%, and below 37% is even better. If your DTI ratio is higher than you'd like, there are two main things you can do: increase your monthly earnings or reduce your debt. We'd all like to make more money, but most of us don't have much control over that. What we do have some control over is how we manage our money. So the first step, and the most important step in managing debt and in managing all money really, is creating a solid budget. Budgeting creates a cash flow plan that allows us to live within our means so that we don't accumulate any additional debt and can work to pay off our existing debt. So financial gurus often recommend that people create a budget following the 50-30-20 rule. And you can see an illustration of this on page 5 of your participant guide. So with this rule, they say that 50% of your income should go to your needs or your necessary expenditures like housing and food, and 30% goes to wants or the fun stuff like hobbies and dining out. And 20% should go towards savings and debt payments. On page 6 of your participant guide, you'll find a budget worksheet. Now, we don't have time to complete this together here today, so I want you to do this in your own time, but I'm going to go over it real quickly here so you know how to do it. You're going to start by recording what you spend each month for needs and wants. Now, those needs are your expenses for necessities like housing, food, transportation, health, and personal items. So under housing, you'll put the amount you spend on rent or mortgage every month. Now, remember that needs does not include anything extra you spend for pleasure or entertainment. For example, the money you spend on date night should not be included in the other necessary food expenses category, even if your partner tries to convince you it's a need. Dining out for pleasure will go in your wants section on page 7. So it's helpful to look at 3 months of bank and credit card statements to get an average of those expenses that aren't always fixed. So when you're done recording your monthly costs, add them up and put that total under the grand total section. So once you have an idea of your current expenses for wants and needs, you can see how well you're doing with this 50-30-20 rule. So to calculate the percentage of income that you use to pay for your needs and wants, you'll take the grand totals and divide that by your monthly income after taxes. So this is different than the gross income we use to calculate your DTI. Your income after taxes is the amount that you actually see on your paycheck. Multiply this number by 100 to get your percentage. So let's take a look at Adidia's percentages. Adidia's monthly income after taxes is $5,000. If we divide his total needs of $3,750 from his income, we see that he's spending 75% of his income in this area, and he's spending 20% on wants. So you can calculate your own percentages using the budget worksheet we just talked about, and then that calculation on page 7 of the participant guide. So if you don't have 20% remaining, you aren't alone. Adidia certainly doesn't. If we look at his wants and needs, he only has 5% remaining. So 20% is the goal. That's the place you're trying to get to. But if you're not there yet, we're going to discuss debt management strategies next. But first, let's talk about how to use this 20%, because when it comes to paying off your debts, there are a few best practices. So if you're following along in your participant guide, you can turn to page 8. So let's figure out how much you have left to work with if you add up your total wants and needs from the budget worksheet and subtract that amount from your monthly gross income. you should get the amount that you should be putting towards your debt payments and to increase your savings. So financial experts recommend that any extra funds be applied to the following accounts in the following order. So first, create an emergency fund with 3 to 6 months of living expenses. Number 2, maximize your 401k retirement contributions if you have an employer match. That means your employer matches the amount that you put into your retirement accounts. Number 3, pay off high interest debt. Number 4, contribute 15% of your gross income, so that's before taxes are taken out, to your retirement accounts like your 401k. And finally, number 5, pay off lower interest debts with anything more than the 20% saved. You can do this by reducing the amount spent on wants. So let's talk about these recommendations because they might not be what we would expect. So why do you think an emergency fund is number 1 on the list? Well, having an emergency fund enables you to cover the cost of emergencies to avoid taking on more debt. If you find it difficult to save 3 to 6 months of living expenses, experts recommend that you aim for at least $500, enough to cover some common emergencies. So what about number 2? Why is it important to maximize the employee match on your 401k? Well, if your employer matches your 401k contributions, this is free money. Not contributing the maximum amount is just throwing away this free money. Plus, the earlier you begin saving for retirement, the greater the potential gains made on your investment. Number 3 makes sense. We want to pay off those high interest debts. But look at number 4 and number 5. Why do you think contributing to a retirement fund is more important than paying off low interest debt? Well, generally, the earlier you start saving for retirement, the more money you'll have when you retire. The amount of money you'll save paying off low interest debt is generally assumed to be less than the amount you'll earn by contributing to retirement early. So as you can see, there's a strategy involved in paying off your debts. Many people focus only on paying off debts without giving any consideration to savings, but this may be a huge mistake. In addition to debt payments, planning for emergencies and retirement are important factors. Neglecting these areas may seem to help you in the short term by freeing up the maximum amount of funds possible to put towards debt, but it's a strategy that may cause you more financial hardship in the future. So you can see from these recommendations how being able to apply 20% of your income to savings and debt payments may benefit you financially. But if you didn't have 20% left over when you calculated your expenses, let's talk about some other ways you can free up some needed funds so that you can increase your debt payments and begin to save for the future. So the first step in freeing up funds is cutting your own expenses. And as easy as it sounds, this is one of the most difficult things to do. And because most of us feel like we're already living paycheck to paycheck. Even though cutting expenses is not something any of us want to do, it is worth it in the long run. If you're following along in your participant guide, go ahead and turn to page 9. So let's think about some ways we can reduce our monthly expenses. Hopefully, your reductions can come from the wants section of your budget. Can you reduce how much you eat out or how much you spend on shopping or personal items? Some cuts can also come from your needs. Maybe you can make cuts to your grocery or your cell phone bill, or maybe it's time to look around for some new car insurance. The next step is to try and find ways to earn more money. Some things to consider are, could you manage taking on an additional job? Is there anything you could sell? Would it help you financially to relocate somewhere with a lower cost of living? Once you have a working budget in place and you've figured out ways to free up funds to apply to debt repayment and savings, you can begin creating a strategy to pay off your debts. So now I am going to turn it over to Charlotte to discuss the next step in debt management, Debt repayment strategies.
Good morning, everyone, and thank you again for joining us. So let's carry on. Now, financial experts often recommend two strategies for paying off debt as quickly as possible. These are known as the Avalanche method and the Snowball method. The Avalanche method focuses on paying off the debt that have the highest interest rates first, while paying the minimum payments on all the rest of your debt. The theory here is that high interest rate debt will end up costing you more in the long run. So it's good to pay these debts off as quickly as possible. The snowball method focuses on paying off the debt with the lowest balances first, while paying the minimum amount due on the rest of your debts. The thinking here is that you can pay off lower balances more quickly than higher balances. Paying off these loans will reduce your debt to available credit ratio and give you a sense of accomplishment. Let's see what these strategies look like in action. Using the avalanche method, which debt would Kaylee pay off first? There's A, the major credit card, then there is the B, the store credit card, and C, the personal loan. If you're thinking that Kaylee would pay off A, that's right. In the avalanche method recommends that you pay off the debt with the highest interest rate first. In this example, that would be the major credit card. After that, you would pay off the store credit card. And let's try the snowball method. Which debt would you pay off first using the snowball method? A, the major credit card, B, the store credit, or C, the personal loan? I'm sure you're thinking B. And if you're thinking B, that's correct. In the snowball method, we recommend that you pay off the debt with the lowest balance first. In this example, that would be the store credit card. After that has been paid, you would move on to pay off the personal loan. Now, great job understanding the avalanche and the snowball method and applying these to Kaylee's debt. Now, let's think about how you can apply these strategies to paying off your own debt. On page 4 in your participants guide, there is an activity for you to record your financial health worksheet. Please review and complete on your own time. I'm going to give you a little bit of instructions on how to do that. For the avalanche method of paying off your debt, which debt would you pay first? Place an A next to the debt that you would pay first. And in the snowball method, if you're going to use the snowball method, place an X next to the debt that you would pay first. And remember to calculate these on your own time. So we've discussed budgeting and ways to free up funds for savings and debt repayment. And we've covered different strategies you can use to pay off your debt. But what happens if budgeting and strategizing just isn't enough? Sometimes, no matter how hard you work the numbers, no matter how much you cut from your budget, or how many additional jobs you take, it's still just not enough. The next section will cover additional strategies for getting control over your debt if you need something beyond budgeting. These strategies will require you to communicate with lenders and seek outside assistance. I'll be referencing various resources available to consumers throughout this discussion. Don't worry, you don't really need to remember them or write them down. They are all listed on page 14 in your participants guide. Before we talk about what to do to manage your debt beyond budgeting, let's talk about what to avoid. This information is listed on page 10 of your participants guide if you want to follow along. The first rule is Avoid just closing out your credit card accounts. While it may seem like a good idea to cancel your credit cards when you're in debt, if you cancel them, you can't use them, right? Canceling your credit cards may actually hurt your credit score. If you don't want to be tempted to use your credit cards, put them in a safe place, somewhere that's inaccessible instead. For an example, I had a friend that would always put their credit cards in the freezer. They would put them in a plastic cup, put them in the freezer, and freeze them. The thought is, by the time I thaw them out, I don't have the desire to spend that money or use that credit card anymore. Secondly, avoid borrowing from your retirement plan. You've worked hard to build up your savings. If you borrow from your retirement account, you may not be able to get back the earnings you've lost. Plus, if you take money out of your retirement account now, you'll be hit with some extra taxes at tax time. And thirdly, be careful about hiring a debt settlement company. Debt settlement is a risky option. There have been many cases of debt settlement companies charging customers without delivering on their promises and providing bad financial advice. Experts warn to never pay fees for debt settlement upfront. Be on the lookout for these red flags if you consider this as an option. And finally, don't hide from creditors. Never hide from creditors. Avoiding your debt won't solve anything. In fact, if your creditors are unable to reach you, they'll probably send your debt to collections. A consequence we'll talk about later. It may be possible to make a deal with your creditors on what you owe. Talking to creditors is number one on this list of dues. Communicating with creditors may be the easiest way to manage your debt. When you don't pay your debt, creditors must spend money to keep contacting you. Therefore, it may be their best interest to help you stick to a payment plan. Try requesting a lower monthly minimum payment or even lowering the interest rate. If you're having trouble paying your bills on time, you may even resort to a deferment. A deferment postpones your debit payments for a limited time, allowing you to get your finances in order. You may also try credit counseling. Credit counseling, credit counselors are usually nonprofit organizations that assist consumers with budgeting and debt management. They can provide you with educational materials, help you create a budget or debt management plan, or may even negotiate with creditors on your behalf. Neighborhood Credit Union has chosen to partner with Green Path Financial Wellness. If you're not sure, contact your state consumer protection agency. These resources are all listed for you in your participants guide. And finally, there's debt consolidation. Debt consolidation or loan consolidation may be recommended if you have multiple high interest loans. This could be the case if you carry a balance on multiple credit cards, have more than one student loan, or even if you have many different kinds of high interest loans, car loans, credit cards, personal loans. Debt consolidation involves taking out a new loan with a competitive interest rate, an interest rate smaller than your existing loans. Your smaller loans are then transferred to this new loan, reducing both the amount you have to pay each month and the total number of bills you have to worry about. This option may be helpful in managing monthly payments or paying off debt in a timely manner. In this example, you can see how debt consolidation was a good idea for Carmen. She was struggling to pay bills for multiple credit card balances. Through her bank, Carmen was able to get a debt consolidation loan that freed her from the stress of managing multiple monthly payments and reduced her monthly payments overall. Even though her balance is the same after debt consolidation, her interest rate of 16.5% is lower than the interest rate for credit card A and credit card C, meaning Karma will have less expensive payments. Debt consolidation is typically available through banks, credit unions, and other online vendors. When research debt consolidation options, consider the following things. What is the maximum amount the lender will give you for debt consolidation? Is it enough to cover your debts? What is the average rate you are being charged in interest for all of the loans you wish to consolidate? Is the interest rate being offered for the new loan lower than this? Is the lender part of a reputable company, such as a bank or a credit union you're familiar with? Will you be able to make the payments on the new loan and stick to the repayment period set by the lender? For more information on debt consolidation, you may speak to a representative here at Neighborhood Credit Union or consult with credit counselor. Okay, the debt management strategies we have just covered are recommended steps in getting your finances in order. But what happens if these strategies just aren't enough? What happens if you've gotten into a serious financial situation that can't be handled with the debt management strategies described earlier? You know that debt is becoming overwhelming when you're unable to pay your bills and collectors begin call. Unfortunately, this is the case for many Americans. About 35% of adults with a credit history has a debt in collections owing an average of $5,178. And in 2019, there were more than 77 there was more than 774,000 bankruptcies filed. If debt has become overwhelming for you, you're not alone. In this last section, we'll talk about what to do if you have debt in collections or if you're considering bankruptcy. Let's talk about collections. When debt payments are past due and you haven't paid your bills in some time, your accounts is transferred to collections. Debt, debt collectors have a poor reputation because some use scare tactics, threats, and harassment when attempting to collect on a debt. Even though these tactics are not always legal, for this reason, when your debt goes to collection, it can be emotionally draining. It will also have a negative effect on your financial well-being. The debt will remain on your credit report for 7 years, and collectors may sue you, leading to wage garnishment, liens on your property, repossession, or even foreclosure. It's important to know your rights in this situation. The Fair Debt Collection Practice Act protects consumers from harassment from debt collectors. According to the FDCPA, debt collectors cannot, these are the things they cannot do. They cannot call you before 8 a.m. or after 9 p.m. They cannot call you at work if you tell them not to. Talk to anyone else except your spouse about your debt. Harass, abuse, or threaten you. This includes using obscene language, misrepresent how much you owe, use lies or deception to collect on the debt. If you think debt collectors is violating the law, you can file a complaint with the Consumer Finance Protection Bureau or your state attorney general's office. If collectors are calling and you're not sure what to do, or if you're not sure the debt is really yours, you may want to consult with an attorney to assess your options, especially if the debt may be beyond the statute of limitations or the legal time in which you can be sued for the debt. A word of important advice: try to communicate with collectors through email or letters sent through certified mail so that you have a paper trail of correspondence should you need legal help in the future. The Consumer Financial Protection Bureau has helpful templates for corresponding with creditors and debt collectors on their website. Bankruptcy can help give you a financial fresh start, but it's a serious step that shouldn't be taken lightly. There are three types of bankruptcy that individuals can file for: debt discharge. Discharge means that certain debt are released from the debtor's responsibility. Chapter 7 and Chapter 13 are the most common. The type of bankruptcy a person files may depend on how much debt they have, their assets, and their wage earnings. For Chapter 7, bankruptcy, you generally have to prove that you do not earn enough income to pay off your debts. Chapter 7 may be an option for people who do not have a lot of liquidable assets or property, as these could be used to pay off some of your creditors. Chapter 13 bankruptcy is an option for people who generally earn a reliable source of income and can make a plan to pay off debt within 3 to 5 years. Bankruptcy is serious because it remains on your credit report for up to 10 years. It may also be a time-consuming, stressful process. Furthermore, not all debt is discharged through bankruptcy. For instance, student loan debt likely won't be forgiven with a bankruptcy filing. At the same time, it allows a person to freeze the pressure of creditors and seek a fresh start. If you are considering filing for bankruptcy, it may be helpful to talk to a consumer or a bankruptcy attorney so that you understand all your options. Whether you're considering bankruptcy or just need to work on your budgeting skills, you're already ahead of the game by just being here today. Many experts think that so many Americans are having trouble with debt and financial instability because we have poor financial literacy, which is a basic understanding of personal finance. Nearly 66% of Americans couldn't pass a financial literacy test in 2018. After taking part in this workshop, hopefully you are armed with more information than most Americans. Are you ready to put your skills to the test? On page 11 in your participants guide, there is an activity, Emily's Financial Burden. We're going to give you that to take and complete on your own. You can complete it on your own time, but it's going to test your skill level on financial literacy. You have the critical knowledge and skills of that are a elite group of Americans who can call themselves financially healthy. With financial health, you'll have far less stress, more confidence, better physical health. and stronger relationships. You'll also have the freedom to do what your debt is preventing you from doing right now, making your dreams come true. Remember to work on your personal budget when you get home and refer to the resources that we have provided for you in your participants guide. And if you have any additional questions, you can always reach us here or you can use those resources that we have. Now that concludes our webinar for today. Thank you so much for joining us. And now it's time for our drawing. It's time for our drawing.